Hello and welcome to our February 2024 edition of Macro and Market Wrap-Up. This month, we put 2024 Interim Union Budget in focus and a bit more. So then, let's begin. The Feb 2024 Union Budget is a vote on account budget, implying limited parliamentary discussion and hence an avoidance to tax modification at large. The primary objective is to seek permission to spend and collect receipts until the new government is formed. The underlying theme of 2024 interim budget was clearly fiscal consolidation with an ability to maintain the infrastructure spend. No populist spending, with the lone exception of rural housing. Allocation for most of the key rural schemes is largely flat in FY25. There is a hope to reduce subsidy outgo too, which in the end would be contingent on evolution of commodity prices through FY25. Fiscal impulse is clearly reducing. Central government total expenditure is budgeted to grow at a mere 6.1%. versus a likely 7.1% in FY24, lower than India's nominal GDP growth. In fact, adjusting for the interest outgo, fiscal impulse reduces further. Perhaps, with India reporting 7% real growth, the hope is for the private sector to take the growth baton now. The pace of fiscal consolidation took everyone by surprise. Despite FY24 being a pre-election year and despite FY24 nominal GDP growth coming in lower than budgeted, the government plans to end the year with a lower than budgeted fiscal deficit. Government now plans to bring down FY24 deficit to 5.8% of GDP versus an initial budgeted roadmap of 5.9%, and then further consolidate it to 5.1% of GDP in FY25. It does lend credibility to their FY26 deficit target of 4.5%. Nominal growth is projected at 10.5%, which looks slightly optimistic to us, but overall receipts are projected to grow by a reasonable 11.8%, versus a revised estimate of 12.2% for FY24. Optically, capital expenditure via budgetary support also appears to be improving from Rs 9.5 trillion in FY24 revised estimate to 11.1 trillion in FY25. However, if one were to look at key infrastructure-oriented sectors such as roads, railways, water, defence and metros, most of them show a low single-digit growth in FY25 capex spend. It appears that a large part of capex is directed towards loan and equity infusion. We compare the colour of centrally sponsored schemes of the government during its first and second term. While the government's first term focused on Swachh Bharat, crop insurance, rural roads and housing, allocation towards MG Narega, housing and National Rural Drinking Water Mission was scaled up substantially in the second term. PM Kisan was introduced just ahead of the second term. Ayushman Bharat, that is public health insurance, Anganwadi and a few of the new agri-oriented schemes were also introduced in the second term. Rural electricity and women are likely to be the focus in the coming years if government stays in the third term too. In line with the convention of a vote on account budget, direct and indirect tax rates were retained. Gross borrowing is markedly lower in FY25 at Rs 14.1 trillion versus 15.4 trillion in FY24. As per our calculation, the actual net borrowing in FY25 falls to 10.5 trillion versus Rs 11 trillion in FY24. Given the continued ability to retain infrastructure spend, reduce the deficit and market borrowing, and no taxation changes in a vote of account budget, The February budget is taken extremely favorably by the fixed income market and neutrally by the equity market. 10-year G-Sec rallied by 10 basis points in a day. The derived government spending estimates from the budget indicate that the banking system liquidity stress should improve over the coming 2 months. Fiscal consolidation and no populist spending has a disinflationary impulse and is favorable from the monetary policy point of view. But for now, the very next day after the budget, RBI announced to suck out a part of liquidity via variable reverse repo auctions, thereby underscoring its liquidity and an overall monetary policy stance. The liquidity deficit in India's banking system has jumped to 2 to 3 trillion rupee. A consequence of the tight liquidity is higher funding costs for banks. Banks' credit to deposit ratio is elevated. T-bill rates moved up to near 7%, while long end was marginally down. The long-short story is that the healthy credit growth, waning liquidity, and an elevated credit to deposit ratio will keep a floor on the short-term rates, unless RBI's liquidity stance changes. Yield curve in India is marginally inverted. At the same time, FY25 is the year to mark the official commencement of India's inclusion in the Emerging Market Bond Index, yielding a positive turn to demand-supply dynamics for the government bonds. And a larger fact remains that the rate cycle has peaked and next move will most likely be a cut. With a 55 basis point spread between 10-year G-Sec and repo and likely status quo on policy rates in the very near term, G-Sec valuations are near neutral. Coming to SDLs, the supply in January has been 77% of the stated calendar. But this is not unusual for January. We do expect average weekly auctions to rise to Rs 300 billion in February and March, given the ongoing nuances of state finances. This could cause SDL G-Sec spreads to widen a bit. Overall, it is still some time away for us to get fundamentally positive on rates. Apart from budget, we have a few other notables from last month. Global trade volumes have been contracting through 2023. Now, we have an extra disturbance at the Red Sea due to escalated conflict in the Middle East. About 40% of Asia's exports to Europe goes through the Red Sea. Even as they are getting routed through Africa now, that makes us lose roughly 2 weeks of exports. And it's a headwind that will slow down global trade in the near term. Rate hiking cycle has ended in the US, but US Fed policy decision in Jan explicitly pushed back the possibility of a rate cut in March, citing that it needs greater confidence for inflation to sustainably move towards 2%. March cuts probability moved down from 70% to 30%. Another development was lower than expected Q1 2024 borrowing by US Treasury. All in all, US Treasury broadly stayed at around 4%. We're talking about 10-year US Treasury over here. In India, the state of Uttar Pradesh has always been politically important. It is a house for 20 crore Indian population and 15% of Lok Sabha seats. But it's increasingly gaining economic prominence too. It's becoming a manufacturing hub for electronics. A large proportion of new private sector capex and public infrastructure creation is happening in the state. And now, with the opening of Ayodhya Temple, it would also garner more of infrastructure and tourism related investment in the state. Coming to the equity market, while the US equity market scaled new highs, the slump in Chinese stocks continued. Exuberance in Indian equities also continues. MSCI India once again significantly outperformed the other emerging markets. While Nifty was flat, performance for mid and small cap was much stronger and most sectors were in green. FIIs were the net sellers but were offset by strong purchases from DIIs. Third quarter FY24 results for Indian companies have broadly been in line. 28 Nifty companies have reported the results thus far at the time of recording. 5% of sales growth has been seen in these companies, but 24% profit growth. Banks reported better than expected numbers, while IT services reported a mediocre performance. Consumer companies struggled for growth for yet another quarter, while the residential real estate sector continues to boom. Hence, earnings remain supportive and mid-teen growth expectations for FY25 seems doable. We continue to reiterate, there needs to be a clearer sign of labor market cracking in the US or a stronger visibility of inflation falling within the target. Until the rate cut cycle gets real close, we could see more of 2023 in terms of asset price moves. That is, any asset class will lack a fundamental clear direction and rally. Signing off for this month. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.